Most people think retirement success comes down to returns. If the return is high enough, the plan works. If the return is too low, the plan fails. That sounds logical. And honestly, it is the way most of us were taught to think about investing. But in retirement, that is only part of the story. The bigger issue is timing. And frankly, it's a much bigger issue. You can save carefully, invest responsibly, choose a reasonable withdrawal rate, and still end up with a plan that feels much tighter than what you expected. Not because you made a foolish decision, and not because the market never recovered, but because the bad years showed up at the wrong time. That is the uncomfortable truth. In retirement, you do not live the average. You live the order. Two retirees can have the same starting balance, the same investment strategy, the same withdrawal target, and even the same long-term average return. But if one person gets strong returns early and the other gets weak returns early, their retirements can feel completely different. That is what we are talking about today. Timing matters more than returns because retirement is not just about what the market gives you. It is about when the market gives it to you. Most retirement plans are built around averages, average return, average inflation, average lifespan, average spending. It all looks clean and manageable when you put it into a calculator. But real life does not show up as an average. It shows up 1 year at a time. You get good years, bad years, flat years, recovery years, years where inflation seems to hit every category you actually use. The order matters, and that order can change the outcome. If strong returns happen early in retirement, your portfolio has a chance to grow before withdrawals do much damage. You get some breathing room. You build a cushion. But if weak returns happen early, the opposite happens. You begin withdrawing from a portfolio that is already under pressure. That same dollar withdrawal now takes a bigger bite out of the account. Same average return, different order, different result. That is why the word average can be so deceptive. It feels precise, it feels mathematical, but it can hide the most important part of the retirement experience. Averages describe markets. Sequences determine outcomes. During your working years, market declines are unpleasant, but they are not automatically destructive. If you are still earning a paycheck and still contributing to your accounts, a downturn can even help you in the long run. You are buying more shares at lower prices. You still have income. You still have a recovery runway. That is accumulation. Retirement is different. In retirement, you are not adding money to the portfolio. You are taking money out of it. That changes the entire risk picture. Now, a downturn is not just a downturn. It is a downturn plus withdrawals. The bills still have to be paid. Groceries still have to be bought. Insurance still needs to be funded. Healthcare still costs what healthcare costs. You cannot tell the electric company, I'm going to wait for the market to recover before I pay you. So if the market is weak early in retirement, you may be forced to withdraw from a portfolio that is already down. That is what makes sequence risk so dangerous. It is not just volatility. It is volatility arriving exactly when you are depending on the portfolio for cash flow. Bad timing turns ordinary withdrawals into structural damage. Let's strip away the jargon. Sequence risk means that bad returns early in retirement can do more damage than the same bad returns later in retirement. The reason is simple. Early in retirement, your portfolio has not had time to grow and you are already withdrawing from it. Imagine you retire with $1 million. The market drops. You still need $60,000 for living expenses. That withdrawal now comes out of a smaller account. You are not just spending money, you are selling a larger percentage of the remaining portfolio. Those shares are gone. They do not participate in the recovery. That is the part people often miss. The market might recover later, and that might sound better. The statement might start moving in the right direction again, but your retirement structure may still be weaker because the base was damaged early. That's why a retiree can feel fine in the moment while future flexibility is quietly being reduced. The market can recover. Your retirement plan might not fully recover with it. Let's make this human. Imagine two retirees. We will call them Alan and Chris. Both retire at 65. Both start with $1 million. Both invest in a similar way. Both follow a disciplined withdrawal plan. And over the next 20 years, both experience the same average annual return. On paper, they look almost identical. But Alan gets strong returns in his first 5 years. His account grows early. Even with withdrawals, the portfolio has room to breathe. Later, when a rough stretch hits, the base is larger. The withdrawals represent a smaller percentage of the total account. The plan has cushion. Chris gets the opposite order. Weak years early, a flat stretch, and then a deeper downturn. Chris keeps withdrawing because he has to. The bills did not stop, life did not pause. So Chris sells shares into weakness. And when the market finally recovers, Chris has fewer shares left to participate in that recovery. Alan feels stable. Chris feels tight. Same average return, different order, different life. That is what people miss. Retirement is not just about what the market returns. It is about when the market returns it. Early losses are not just emotionally painful. They are mathematically hostile. When a portfolio is down and you withdraw from it, three things happen at once. First, the portfolio value is lower. Second, the withdrawal represents a bigger percentage of what remains. Third, the assets you sell are no longer there to recover later. That is the sequence problem in its simplest form. Late gains are not equal to early gains. A gain that arrives after years of withdrawals does not repair the earlier damage in the same way an early gain would have strengthened the plan from the beginning. A portfolio is not just a scoreboard. It is a machine that has to keep producing cash flow. If you remove too many pieces from that machine during weak years, the machine's future output changes. That is why people can look at average return assumptions and think the plan should still work, while the actual lived experience starts getting tighter. It is not because the math is fake. It is because the math was incomplete. Timing changes the base, and the base changes everything. Now let's add another layer. Inflation. Poor timing gets worse when costs are rising. People hear one inflation number on the news and assume that is the whole story. But retirees do not spend one inflation number. They buy groceries, utilities, insurance, prescriptions, repairs, healthcare. Those categories do not all move evenly. Some of them rise faster than the headline number, and some hit retirees especially hard. Now imagine poor returns early in retirement combined with rising real life costs. The portfolio is down, but the spending need is up. That means larger withdrawals may be happening at exactly the wrong time. At that point, this is not just a market problem, it is a structure problem. The sequence of returns is colliding with the sequence of costs, and the retiree is stuck in the middle. This is why average return thinking is not enough. A retiree does not just need returns. A retiree needs returns arriving in a pattern that can support spending without shredding the base. When that does not happen, the pressure usually shows up quietly, not as disaster at first, but as compression. This is where the problem becomes more than mathematical. Bad timing changes behavior. When someone experiences weak returns early in retirement, confidence often erodes before the spreadsheet fully shows the damage. You check balances more often. You pay more attention to headlines. You hesitate before spending. You question decisions that used to feel comfortable. That psychological shift matters because people under pressure rarely behave perfectly. Some people freeze. Some deny the problem. Some cut too much too late. Some refuse to adjust because they are anchored to the original plan. Others panic and change investments after the damage has already been done. This is why timing is not only an investment issue, it is a behavior issue. A retiree with a fragile structure and no decision framework is more likely to react emotionally to bad timing. A retiree with buffers, guardrails, and a plan for what to do in a bad market is more likely to respond calmly. That difference can be enormous. Pressure changes behavior, and behavior changes outcomes. One of the most misleading phrases in retirement planning is the average return is fine. That sounds reassuring, but what does it actually tell you? It does not tell you whether the bad years came first. It does not tell you whether withdrawals were rising. It does not tell you what inflation was doing. It does not tell you whether the retiree had enough liquidity to avoid forced selling. It does not tell you whether the retiree made calm decisions or emotional ones. It tells you what the market did in general. It does not tell you what the retiree experienced specifically. That is why retirees should stop asking only, what average return do I need? A better question is, what happens if returns arrive at the wrong time? That is a more honest question because retirement is not an academic exercise. It is a lived sequence of years. You do not retire into a spreadsheet. You retire into life, and life arrives in order. You do not live the average, you live the sequence. Imagine two portfolios again. Both start with $1 million. Both end up with the same average return over 10 years. Portfolio A gets several strong years first. The account rises before a downturn hits. By the time the weak stretch shows up, the base is larger and withdrawals represent a smaller share of the account. Portfolio B gets several weak years first. The account declines while withdrawals continue. Then the stronger years arrive later. On paper, the average return might look identical, but the outcomes are not identical. Portfolio A had the chance to build strength before stress. Portfolio B got stressed before it had built any cushion. Now add a $60,000 annual withdrawal. Portfolio B is forced to liquidate more assets at depressed prices in those early years. When later gains arrive, fewer assets remain to participate. That is why the eventual rebound does not completely fix the earlier damage. Same average, different path, different result. Sequence risk is not about the market doing something bizarre. It is about normal market volatility arriving at a structurally vulnerable time. Let me describe the moment many retirees feel this too late. It does not usually happen in a dramatic crash. It does not happen with someone shouting, "We are ruined." It happens quietly at the kitchen table. Papers are out. A calculator is nearby. Nothing urgent is happening. Nothing catastrophic has occurred. You are not broke. You are not panicked. But something feels thinner than it used to feel. You used to glance at the portfolio. Now you study it. Now you test every plan against the numbers first. You used to say yes. Now you say maybe next year. That is what bad timing can do to retirement. It reduces freedom before it destroys balances. Most retirees do not experience failure as one dramatic event. They experience it as a slow loss of confidence and optionality. That is the real life version of sequence risk. Most retirees do not run out of money first. They run out of flexibility first. So, what does a structure look like that can survive bad timing? You do not solve bad timing by predicting the market perfectly. Nobody can do that consistently. You solve it by building a plan that can survive unfavorable timing. That means liquidity. It means flexibility. It means separating essential spending from discretionary spending. It means building buffers that allow you to avoid selling risk assets during weak periods. It means reviewing the plan regularly instead of worshiping a static number forever. A resilient retiree says, if the first years are weak, here is how I respond. A fragile retiree says, I hope the average works. That is the difference. Not prediction, preparation. Not certainty, resilience. The goal is not to eliminate uncertainty. The goal is to keep uncertainty from breaking the structure. Returns matter, of course they do, but timing matters more than most retirees realize because retirement is not just about what the market produces. It is about what your plan can withstand when the market produces it at the wrong time. That is why averages are not enough. That is why sequence matters, and that is why sequence matters most of all. If this helped you think about retirement differently, that is the point. A strong plan is not just built for good markets, it is built for bad timing. Because retirement does not usually fail loudly, it tightens quietly. So remember this, you do not live the average, you live the sequence. And that is why timing matters more than returns. If your retirement plan only works when the markets behave and life cooperates, that doesn't mean you failed. But it does mean you should stress test it. Not to scare yourself, not to chase perfection, just to protect your options. If you want, I'll put a simple retirement reality check worksheet below this video. It's not a sales pitch. It's a set of questions that reveal weak spots before they become expensive. Use it, mark it up, and talk it through with whoever helps you plan. And remember, planning isn't predicting. Planning is preparing. Because in retirement, the ability to adapt is worth it.